welcome to MF Basics. I'm Lisa and you're watching episode 7 where we are talking to you about passive funds. So far we have spoken about mutual funds in general, equity funds, debt funds, hybrid funds, gold funds. However, mutual funds are actually divided into two broad baskets. There are active funds and there are passive funds. Now, active funds are those where there is an active involvement by a fund manager to actually build the fund portfolio, select the securities, the asset allocation, and all of that. In passive funds, there is no involvement of a fund manager. How it works is that the portfolio of the fund is aligned to an underlying index. It could be equity or it could be a bond index or a debt index, and the returns are then aligned to what that index does, and that is what you will find in your passive fund. Passive funds are of two types in the domestic mutual fund market. There are exchange traded funds or ETFs, and there are index funds. Let's talk about exchange traded funds first. Remember, we spoke about it, gold exchange traded funds, gold ETFs. Well, there are ETFs in equity and in debt as well. So exchange traded funds are essentially a type of fund that actually mirrors an index. So if you have a Nifty ETF or Nifty exchange traded fund, the fund will basically have all the stocks which are there in the Nifty 50 index and in the same proportion, same weight. ऐसा है कि आप अगर निफ्टी ETF खरीद रहे हैं तो it's like buying the Nifty 50 itself, just in an ETF platform. And the main difference between exchange traded funds and index funds is that ETF can be bought like a stock. आप ETF को अपने ब्रोकर के थ्रू स्टॉक एक्सचेंज में खरीद सकते हैं और बेच सकते हैं. So that makes it easy for a lot of people to buy ETFs. Now, ETFs are found for the main indices, majorly for Sensex and Nifty 50, but there are others also. You can have sector-based passive funds and ETFs, like banking के बहुत सारे ETFs हैं. Also, there are certain sort of specialized index-based ETFs. So those are called smart beta. वो भी that index is available in the Nifty basket, for example, or in the Sensex basket, और उस पे ही वो ETF mirror किया जाता है. Something like a quality index, Nifty में अगर आप देखेंगे Nifty indices में there is a Nifty 50 quality index, so उसका भी ETF आपको मिल सकता है. So there are different kinds of ETFs, and also to invest in international funds there are ETFs available. So there are different kinds of ETFs available. Remember, ETFs you have to buy and sell on the stock exchange itself, and you need a demat account to invest in an ETF. The biggest advantage of investing in an ETF is that it comes at a very, very low cost. There are equity ETFs, Sensex and Nifty based ETFs, which come at a cost of 3 paisa per 100 rupees. So that's like really, really, really low, and it really helps investors who want to start giving themselves some kind of equity exposure to buy a product which comes at such a low cost. However, there are also some issues with ETFs. Firstly, you may have volume issues. There is not a very large amount of trading that happens in ETFs on any given day. And there are, times where you'll just see a few thousand rupees worth of turnover, just a few hundred units of ETFs traded in the particular ETF that you own, but you have a variety. All the major fund houses have an ETF available. So you can choose the ones with the large AUM if you think that you will need to trade in it more often than not. Ideally, even an equity ETF should have a place in your long-term allocation. So you shouldn't be trading in it really. But if you need to, or if you feel that you will be withdrawing or adding more often, then maybe go for an ETF which has a large assets under management. You can always check that. The other thing is that that ETFs require demat accounts, like we said, and not everybody has a demat account. And that's where index funds come in. So index funds are similar to ETFs. They only invest in a portfolio of stocks that mirrors the underlying index. It could be again Nifty or Sensex or Nifty Junior, or it could be specialized indices, or it could be sector indices. And the only difference is that in the index fund you can actually buy and sell like a mutual fund. It has a NAV and it is not traded on stock exchanges. You have to apply to the mutual fund. So for those people who don't have demat accounts, index funds make more sense than ETFs. The cost could be slightly higher, but still these are very, very cheap. The costs are much lower than active funds. So active funds, equity funds may come at a cost of 2 to 3% per annum, whereas your index fund will come at like 10 basis or 15 basis points, or like the ETF we spoke about, which can come at 3 or 4, 5, 7 basis points as well. So the cost differential is quite substantial. The other advantage of an index fund is that you can do a monthly systematic investment plan through your asset manager. So the index fund allows you to invest, say, 1,000 rupees every month through an SIP, which you can't really do in an ETF, at least not through your asset manager. If your broker allows you to do a SIP in a ETF, that's a different issue. You have to check with your broker, but you cannot do it through your asset manager, right? So index funds, ETFs are quite similar. Their returns will be quite similar, which will mirror the returns of the index that they are copying. And the costs are very low. So that is the real advantage of passive funds, that the costs are very low. Are they worth investing in? Well, let me tell you a trend that we have seen in the last 3-5 years. Passive fund returns, ETF and index fund returns in the domestic market are now challenging large cap mutual fund returns. So if you see the 3-year return, 5-year return, the top 10, 15 performers are your passive funds, your index funds and ETFs. We know that the market is quite polarized. Index gains are not reflecting in the broader market, and that's showing up in your ETF and index fund returns as well. There is also a theory that probably because the markets are getting more and more efficient, the large cap segment has really shrunk in terms of delivering active alpha. So the fund manager has very little sort of specialized analysis or information that can add value as compared to the market in general. So at least in the large cap space, where you're really looking for those 2 or 3 active funds which are beating ETFs and index funds, maybe it's better not to get into that. Avoid the whole fund manager risk and just stick to passive funds. Remember, we had done this how to choose an equity fund in one of the earlier episodes, and it's not an easy task. You really need to do your research and your homework really well to pick that right fund manager. And when you're investing in passive funds, that risk is taken away. What if you pick the wrong fund manager? What if you pick the fund house where fund managers keep changing? All those risks remain with active funds, but passive funds don't have that problem. So at least a portion of the portfolio can go into funds like this, where you don't have to worry about the fund manager risk. The cost is really low, and you're investing in an index, which is a market benchmark, which is a popular index, and you can sort of estimate a kind of trend for a long-term allocation. Now, we spoke about passive funds in the equity space, but you also have a choice of long-term, medium-term, and short-term passive allocation in the debt fund space. There is something called the Bharat Bond ETF, which can give you different options, medium to long-term allocation in debt. Again, comes at an extremely low cost. I think it's a negligible cost. And it gives you access to a very high quality portfolio, AAA rated portfolio, where you can lock in for 3 years or for 10 years. And different tranches will keep coming, so you'll keep having the opportunity to invest at the current interest rate cycle. So those are a very good way to build your debt allocation, medium and long term. Then there is something called liquid Bs, which is very short term it's an ETF format, and it's very short term, a few days to a month, where if you have surplus money from the markets which you need to park for a very, very short term, liquid Bs comes into play. So equity and debt have this ETF format. Equity also has a lot of index funds which you can use. And then, of course, there are gold ETFs, which we've already spoken about in the previous episode. So passive funds are also an interesting way to get exposure into market-linked products in the equity, debt, and even in gold. Hope this was helpful for you. Do keep watching MF Basics for all things mutual funds.